Hello investors, welcome back to the channel. Today let's dive into Varun Beverages, PepsiCo's biggest franchisee and one of India's fastest growing FMCG compounders. Everyone wants to know if Varun Beverages is a value pick right now or if the stock has become too expensive. Let's break it down together. Varun Beverages bottles and distributes top PepsiCo brands like Pepsi, Mountain Dew, Tropicana, Sting, and Aquafina. With its huge distribution network, deep rural reach, and growing international presence, the company has been investing a lot in expanding capacity and launching new products. This aggressive strategy has helped Varun Beverages capture more and more market share each year. In the most recent quarter, the company posted a profit growth of 5% compared to last year, even though revenue dipped a bit. Margins had improved as well. Operating margins have gone up, and gross margins are looking quite healthy. Another positive sign is that Varun Beverages has been consistently reducing its debt, so the balance sheet is much stronger than before. If we look from a value investing angle, Varun Beverages stands out in many ways. Return on capital employed is at 21%, much higher than the industry average, showing how efficiently the company is using its money. Profits have grown at a super pace, around 41% compound annual growth over the last 5 years. The only thing to be careful about is the valuation. The stock is trading at a high multiple, with price to earnings above 55, and price to book also on the higher side. Most fair value calculators indicate that the stock is about 30 to 35% above its fair value estimate right now. Some strong points really stand out for Varun Beverages. Its partnership with PepsiCo brings enormous brand power and reach. Even when revenue takes a hit, the company has managed to expand its margins. Debt levels keep dropping, which gives more flexibility for future growth. Most importantly, Varun Beverages has a great track record of reinvesting at high returns on capital, making it a top pick for those looking for long-term compounders. Of course, every stock has risks. First is valuation risk. Buying at such high multiples means a lot of future growth is already built into the price. The business itself is seasonal and cyclical, so summer quarters are strong, but there can be dull periods in off-seasons. Rising costs for things like sugar, packaging, and energy can squeeze margins. And finally, the company's success is closely tied to PepsiCo, so any changes there can directly impact performance. So what's a good approach here? For short-term traders, look for entry near technical support zones and set realistic targets with proper stop losses. Long-term value investors should be patient and wait for the stock to correct. Lower levels improve your margin of safety, so use dips to accumulate slowly instead of chasing at the top. To sum up, Varun Beverages is a top-notch compounder with solid fundamentals, strong margins, and a good track record of rewarding shareholders. But the valuation is steep right now. For value seekers, patience is wise. Wait for opportunities during corrections to build a position over time. If you enjoyed this analysis, don't forget to like, share, and subscribe.